Welcome back. The SGX Nifty has extended its slide. It's now down close to about 95 points. When we started Bazaar at 8 a.m., the SGX Nifty was lower by 25 points. So there is more weakness in store, at least in opening trade. Currently down close to about 0.5%. In fact, most of Asia is under pressure. Hang Seng is down close to about 1%. Taiwanese markets have a red tinge. They're down about 0.7%. So there is weakness across the Asian market screen as well, barring barring Nikkei, where Bank of Japan has done some intervention, some changes and tweaks in the Bank of Japan policy meeting. So that's fueling the rally that you can see in the Japanese market. But X of that, the Asian market screen is red and the SGX Nifty has sunk a bit lower. But as we have lack of short-term fundamental triggers, it's all about the momentum in individual stocks. So let's get to our momentumizer. Vivek is here with his stock. Vivek?
Well, good morning. One particular stock that we have on our radar is an auto ancillary company. It's called Mahindra CIE. Now, this particular stock, just having a look at the stock tracker or the stock movement, this particular stock technically is trading about 50, 100 as well as 200 DMA. The stock is up 16% in the last 3 trading sessions, and in 2022 itself, it's up almost 42%. So clear outperformance seen over there. And let's see what's been the trigger, that's actually led to the rally in the last couple of trading sessions. Number one, remember this particular company is a listed subsidiary of a global automotive major CI Spain. India, however, remains a major focus of operations for this particular company. And interestingly, Mahindra & Mahindra, that lends its name to the company, holds almost 9.25% stake in the company. On 14 December, the management said that they're looking to hive off the German truck forging business, and they have started actively looking for buyers for that particular business. And also, along with that, they've also said they're looking to change the name of the company to CI Automotive India Limited. So we spoke to a couple of analysts to get a sense of, why this particular announcement has been made. A main reason that analysts say it's a positive trigger given the fact that the German truck forging business actually had a single-digit margin and was a drag as far as the return ratios were concerned. Also, what they said, the business had been scaled down of late. The other important trigger for this particular company, for a re-rating as per analysts, is that what exactly does Mahindra does with its remaining stake. So it's going to be an important stock and an important development to track as far as this particular name is concerned.
Okay, Vivek, thank you very much for that. Dipan, any thoughts on Mahindra CIE Auto? Vivek was just telling us fundamentally the India business, which is exposed to the passenger vehicles, the MHCV, that's doing well. But it does have the risk of what happens to EU if there is going to be a recession. So fundamentally, your thoughts on Mahindra CIE?
Yes, I think I echo that same concern, that because a large portion is coming from Europe and we are seeing things just not stabilizing in the key market for them, it's better to avoid Mahindra CIE. I'm very positive on auto ancillary, but I would prefer to go for companies which are focused largely on the domestic market, especially on the electrical, electronic side. Companies like Uno Minda, Minda Corp, Sona, BLW, I think these are all very interesting companies, and they are not really impacted by the surge of EVs. So I prefer to go with those companies rather than Mahindra CIE, which has got not only exposure to the European market, but some amount of exposure to engine components as well.
Thank you very much for joining us this morning. Let's move on. We're awaiting the pre-market opening rates. But as we do that, let's talk about Market Laser.
Rima, so what we have on Market Laser today is something on the lines of watch how it pans out, quote unquote. Nothing actionable with what I'm putting out today. But you would have seen, if you're on social media, Twitter, etc., you would have seen posts talking about an explosion of COVID cases in China, right? Now, some of these posts with videos, etc., have been outright alarmist. I saw one which said thermonuclear and situation is as bad as very, very bad. So I would say some of this stuff is very alarmist. But in any case, if you go by mainstream media, if you go by reportage coming out of China, etc., it seems clear that cases in China are rising sharply. Now, this is not entirely surprising because China recently relaxed its zero COVID rules for the first time in years. So while the rest of the world, including India, has seen wave after wave, first wave, second wave, third wave, and so on and so forth, for China, this perhaps could just be wave 2, right? So they're reacting to something which the rest of the world has kind of gotten through, painfully, of course, but also successfully, and the rest of the world is kind of, in a way, back to normal. which is not the case for China. Now, officially, COVID-related deaths in China are only a little over 5,000 since the start of the pandemic. I mean, if this number is anywhere near true, it's incredible for the most populous nation on the planet. But this also means, I mean, if this number is as small, this also means that this is a population which doesn't have too much virus exposure and hence natural immunity. Also, although 90% of the population there has gotten a shot, there are serious questions about the efficacy, the effectiveness of the Chinese vaccine, etc. In any case, I think we will find out in the coming days. Why is this relevant to track? As I said, this is on the lines of keep on your radar and watch. There are two reasons. One is, will this impact China's reopening momentum, right? They're reopening in a big way. It's the second largest economy in the world. It's important for commodities. It's important for pretty much everything, right? Oil, etc. Will this impact China's reopening momentum? And number two, could we see other countries react proactively if they assess that the situation in China is bad and start with travel restrictions and so on and so forth? So, as of now, this is on the sentiment side, the earnings impact straight away may not be large, but the multiple impact perhaps if things do get bad, let's hope they don't, perhaps is something to watch out for. So this, as I said, nothing actionable, but just on the lines of to watch out for in terms of how this really progresses as China continues to reopen. Nigel.
All right. Well, thanks a lot for that, Prashant. Well, let's move on then to discuss the consumption space now and the trends that are seen in the e-commerce and quick service. Well, we're joined by Abneesh Roy, Executive Director at Nuvoma Institutional Equities, who joins in. Hi, Abneesh. Morning. Always good hearing your thoughts. Abneesh, I wanted to ask you, this entire push online, are you seeing it more in only urban cities, or do you believe that, in fact, you're seeing that even percolate down to tier 2, tier 3 as well?
Yeah, thanks, Nigel. So definitely e-commerce has definitely picked up even in the rural areas, thanks to Geo, thanks to the overall rates coming down past few years. So across the companies, we do see that not just urban India, even the midtown and the smaller cities have caught up. And even in the rural areas, we are seeing increasing signs of that. Having said that, now with life coming back fully to normal to pre-COVID, we are also seeing the physical part of the buying coming back fully. So I think both will coexist. We also need to see how the D2C startups, how they fare. Clearly, liquidity has dried up. We are seeing a lot of M&A. Unilever, for example, acquired 2 D2C companies just 2 weeks back. So that trend is also there, that all these e-commerce players, D2C startups, which do not have a proper funding, I think there is a challenge there. So my sense is long-term, both will coexist, but near-term physical retailing is also coming back strongly.
Any indications of how this November, December, actually October, right? The demand has been for the FMCG companies. Where is it that we've seen a lot of traction? What are your channel checks suggesting by way of trends?
Yeah, in the FMCG now, from a rural yardstick, there is some base effect which is helping, but structurally, I think rural demand still remains quite challenging. Unless the rural consumer sees deflation in terms of his consumption, say diesel, fertilizer, general inflation further, I think till then rural recovery is still awaited. But yes, because of base effect benefit, the rural slowdown is definitely tapering down. Just to give you some numbers, earlier as per Nielsen, the rural volumes were declining almost high single digit. Now I think it has come down to more like mid single digit, but still currently urban demand is growing faster. In terms of categories, I would say that definitely biscuits, noodles are still growing faster than many of the other segments, but that's because of down trading. And definitely the market share gains are happening. So we would expect Hindustan, Unilever, Britannia, Nestle to outperform most other staple companies in Q3 and Q4 both. Q3, the margin recovery will be gradual. The real margin.
Oopsie.
Okay, we've snapped that connection, but we've managed to reconnect with Abneesh. Abneesh, go ahead. You were telling us about how rural is seeing a slowdown now. The decline has just been in mid-single digits versus double digit earlier.
Right, you're absolutely right. So we expect Hindustan Unilever, Nestle, and Britannia to outperform most of the other staples because biscuits and noodles are growing faster. In terms of margins, we expect recovery in Q4, the bigger recovery because of the lagged effect. Q3, there will be some expansion of margins versus the first half. But in terms of the YOY, I think the real improvement will start from Q4. And rural recovery, my sense is also will start more from Q4, somewhere in Q4. In Q3, rural structural recovery for FMCG has still not happened.
All right, Abneesh, one stock that's going to be in focus is Dabur, and that's opened with a cut of around 2.5%. The promoter's selling a small stake out there. What's your current rating on the stock? And if you could tell us how you're viewing this development.
Yeah, I think this development, which I think has come yesterday, this is very rare, right? In FMCG, promoter stake sale is very rare. Of course, investors will not necessarily see this as a very positive, so they will await clarification whether this is a one-time. Yes, promoter stake in Dabur is quite high at 67%. Out of that, if they are selling 0.8, still it's a very high promoter stake. But is it one time? Second is, as I said, because the rural demand still recovery is awaited, and winter also has not really met full expectation in terms of the initial euphoria that it's going to be a strong winter. Dabur will be slightly middling in terms of our pecking order. So we have a buy. It's a great play on the rural recovery in FY24. And now the immunity part of the portfolio, which was a challenge, I think that has gone away. But investors would have some questions on why this promoter stake sale, because in terms of dividend, if you see, Dabur has around 50% dividend payout. They pay around 600, 700 crores dividend to the promoters. So why further?
Okay, we'll try and reconnect later. But Abneesh, thank you very much for joining in. Let's get in our 9-10 calls as well. We've got our experts with us. Sudarshan, what do you have?
Well, the Nifty could be choppy, stay away. Buy Bharti Airtel with a stop under 826.
And Mitesh?
I'd go with the long on Hero Motors with a stop at 27.50 for targets of 28.45.
Let's get in some stock ideas as well as we await the opening rates. Dabur is a stock which is top of mind. Promoters are looking to sell about 0.8% stake. There are questions whether this will persist. Is this a one-time exercise? But let's get in more details. Vivek is here. Vivek?
Well, good morning. As you alluded, two promoter entities, one owned by Amit Burman and the other owned by Saket Bowman, are looking to pay stake a little less than 1%. This particular size of the deal or the block deal that is likely to happen in today's trading session is estimated at slightly over 800 crore rupees. Now, important part is, the deal pricing. The deal is expected to be at a 4% discount to the current market price. So offer price base is at 565 rupees a share. There is a lockup for the residual stake of up to 60 days. Interesting to see, how the stock will react to this particular news today.
Okay, all right. Thanks a lot for that, Vivek. Well, Rima, run us through Hinduja Global as well. That's another stock we're tracking.
The board approved a 1,020 crore buyback yesterday. It's a tender buyback. The maximum price is 1,700 rupees per share. That's a 21% premium to where the stock closed yesterday, which is roughly 1,400 rupees. The company is sitting on a strong cash balance. 1,672 crore is the cash on its books as of 30th of September. Remember, the company had sold its healthcare business for close to $1 billion. So they had a lot of cash. They've been using it for making acquisitions. And now this buyback as well has been approved. So that's about Hinduja Global Solutions.
Global. All right, Mitesh, I think you're still with us. There's 2 minutes to go for close. Mitesh, I don't know if you have any thoughts. Hinduja Global, chartically speaking.
I haven't been tracking it, Prashant, unfortunately.
Okay, no problem. What about sugar names, which for the last 2 days have been jumping? I mean, the smaller the better, bigger moves. Anything catch your eye there? Dhampur, Rugar, Pony, Balrampur, of course, Bajaj Hindustan, yeah.
We had a buy on Balrampur a couple of days back, and it was also a top call. I think very strong setup over here. That's the only stock which I'm tracking. The breakout suggests that the stock could head towards 430 or levels. And I think yesterday, while it came out from higher levels, I think this gives you a good buying opportunity with the stop below 385 on the stock, and I think 430, 435 remains a positional target.
UTI AMC yesterday saw a very large move. Is it taking out any levels quickly?
Yes, there's a big gap breakout, and that's how the stock caught my eye. I think, again, a good trend which has started on the upside. 950 is the target.
Okay, all right. Thanks a lot for that, Mitesh. Photo finish just in time. Well, we're waiting by for the initial trades. For the starters, the SGX Nifty suggesting we like to start at the back foot, and the Nifty as well opens with a cut of closure around 80 points odd. What's dragging us in trade? HDFC Bank, that's the one that's down closure around 1%. The HDFC Twins, actually, both of them are down 1%. And they're going to be the big swing factor today. JSW Steel, because of the rising COVID cases in China, well, that one's opened up on the back foot. You have the other metal stocks as well. Just put up the metal index. Well, that's the one that, in fact, has opened up with a bit of a cut in today's trading session. On the flip side, you also have Maruti, actually. That's down closer on 1.2% as we speak. While in terms of gainers, well, few gainers actually. Only Adani Enterprises from the frontline index or from the Nifty stocks that's opened up in the green. I'll tell you what, the Nifty Bank actually is at a very, very crucial spot because it's opened up with a cut of closer on 200 points. It's pulled back closer on 50 points very, very quickly. It went down to around that 20 DMA, 43,278. That's the 20 DMA out there. It's hovering in that vicinity. You'd like it to hold on to those levels if, in fact, the Nifty has to stage a bit of a fight back. But for the time being, the mid-cap index, Rima, is doing a relative outperformance. And you have Dabur, that's the big one in there, with a cut of closure around 2.5% from the broader markets. What else?
Indeed. So Dabur is down 2.5%. Sterling Wilson Solar has lost 2% in opening tick. And Just Dial, that's the other one, down 1%. These are the three stocks where we are expecting some promoter stake sale, promoter selling to take place in the next couple of days. On the gaining side, NBCC, after the company won orders worth 69 crore rupees. IRB Infra, there is a board meeting on 4th of January for a stock split. And Ramco System, board meeting on the 22nd of this month, that's a Thursday, to consider some fundraise. That stock has gained close to about 2%. On the losing side, sugar names are coming in for profit booking. So Sakti Sugars is down 5%, while Rana Sugars has slipped 2.3%. A couple of these banking names are also weak in trade. So UCO Bank down 3.5%, weakness coming through in South Indian Bank. GIC, a stock which rallied hard yesterday, very strong volumes. We saw some solid momentum, but today it's giving up some of those gains, and currently it's down close to about 2.2%. Some of the other winners include Sunflag Iron, Lloyd Steel. These are small commodity placed steel companies which are doing well. Yesterday as well, these stocks were significantly higher in trade. All in all, if you look at the benchmark indices, down close to about 0.5%. The big knock is coming in on the Nifty Auto Index. That's down 0.8%. IT continues to remain the pain point. Nifty IT Index slips for another day in a row. It's down close to about 0.5%. But remember, NASDAQ as well was weak. And there is a large trade which has taken place on Dabur. 1.9 crore shares amounting to a little more than 1% equity has changed hands in a block deal window. The stock is still down 2.6%.
Oh, yeah. I mean, that's the large FMCG name, which Abnish was also talking about. Unusual, but it's happened 2.5–3% lower is what the start is for Dabur. The market is down 110 points. I think, yesterday's low, by the way, is what we were referring to earlier, which was, I think, 18,244 was the low. Today, we are at about 18,310, which is, about 60 odd points away from yesterday's low. So there is still distance, but I think at least initially that will be the one to watch out for. Shipping Corporation of India, I think we highlighted, that's up 5.6%, 148 on Shipping Corporation. There is IRB, which is up about 2.5%. We had the IRB management with us recently. Just a few broader market names with volumes and price gain. So there is SCI, and then there is IRB Infra. GIC Housing is up 2%. It's coming up with decent volumes. DFM Foods 2.6 higher. Sunflag Iron is up 4.25% or so. And I can once again at least spot Ugar Sugar, which is up 3.5%. There is Pony, which is up about 2% or so. It's very, very small names, but they are coming up on the radar. The advance decline gap is very, very narrow. Only 100 stocks separate advances and declines in favor of advances. So let's see how this goes. Maruti is down 1.5% on decent-sized volumes. The top volume-led loser is Dabur, of course, with that block. But Maruti is down with the 1.5% cut. Bajaj Hindustan, I think we highlighted. UCO we highlighted. GIC-RE saw that big pop yesterday. It's down 1%. So slow kind of start. UTI AMC saw a very large gap, which we were just discussing with Mitesh. That is starting about 1% lower. These are just kind of follow-through, or rather the lack of follow-through from yesterday. And Hindalco, I think Nigel mentioned metals, JSW Steel, etc., which are starting slightly lower at this point in time. So we got what? A 100-odd point cut, 18,320.
Just one word on SCI. The weekend there was a notice that came out with regard to the demerger, of the entity. I'm just looking at it over the weekend. And I think they've fixed the demerger record date. That's been fixed for 29th of December. So because of that, I think we're seeing some bit of buying. Yesterday as well, the stock did pretty well. It recovered from the lows of the day. And today as well, it's up close to around 5%. The other one that I want to look at is just take a look at Realty. You have the promoter entity of Dabur that's gone ahead and sold some stake. So, the promoter entity has taken a couple of other names. So, we are not sure what's going on out there. But for the time being, Realty has moved to the high point of the day. The stock is up close to around 2% or thereabouts. And the other one as well, Everready, where the promoter entity has some stake. I think that one as well, the last time I checked, was up close to around 1% or thereabouts. So, it'll be interesting to get some clarification from the management as to what they want to use this money for. It's a promoter entity. So, we'll keep an eye out on that front.
No, absolutely, Nigel. Both Religare and Everready are two of the large listed investments that we know of. There is lots of private investments and private businesses which promoters run. So we don't know where this money will be used for. But these two, at least from a listed point of view, are important to track. 177 on Religare right now. What else? I mean, I think tech is once again slightly lower. HCL Tech, at least I can spot, is down about 1%. Yesterday, the only two large noticeable losers were Infi and TCS after that Accenture result and guidance, etc. Still only initial kind of rates coming through. Suzlon has seen a very large move. Suzlon is up recently, and it's up another 4% now. So 12 rupees or so on Suzlon. SCI we already mentioned. Anything else? HCC, these smaller, long forgotten kind of names are all making a comeback. And I think I would kind of throw in a fact, etc., these Madras Fertilizer, fact, etc., in that same bucket. JK Paper is up about 2%, 2.5%. So Sunflag, I think we already mentioned. Suprajit is up 6%. That's a big one with decent sized volumes for this point in the day. And Lemon Tree is another one which is starting higher. So that's a bit of color overall, which we have at this point. Techem is down 1.25%. Lever is down about 1.25% on the other side. Dr. Reddy's is down 1.5%. So there is enough on the downside as well, which is coming up right now. Deepak Fertilizer is another one which is down 2%. I think we have the management joining us a little later on the program. Okay. How can the auto industry grow with a 50% tax rate, asks Maruti chairman R.C. Bhargava. The industry veteran called for reducing taxes across the auto sector. Parikshit, my colleague, caught up with him. Listen in.
Yes, just days after Ministry of Finance clarified on the definition of an SUV for the purpose of cess and taxation, R.C. Bhargav, chairman of Maruti Suzuki, said, how can we expect the industry to grow when cars have a tax rate of 50%? He was talking about SUVs which attract a cess of 22% and a GST of 28%. R.C. Bhargav called for rationalizing the tax rate all across automotive segments with a special focus on reducing the regulatory burden on small cars, as the market for small cars has been shrinking over the years. On FTAs, Mr. Bhargav went on to say that we must drop the protectionist attitudes, we must reduce our tariffs so as to get access to global markets, and today we have products that can compete on a global scale. When asked about manufacturing, Bhargav went on to say that the reason why we're not seeing a strong pickup in manufacturing is because the government's intentions, government's policies are not being executed properly on the ground. Even with regard to taxation, he said, we cannot be following European and Western examples blindly. They must be translated into the Indian context. When it came to plugging loopholes in Maruti's product portfolio, Hisashi Takeuchi, the MD of Maruti Suzuki, said that 2 SUVs are going to be showcased at the Auto Expo. The company's electric vehicle plan is on track as well.
All right, we'll have more on that story a little later. Pramod Gubri is co-founder at Marcellus Investment Managers. He's joining us now to take some questions. Pramod, great to have you with us here. Thank you very much. As we kind of go through this year, wind this year down, I mean, there are lots of surprises coming our way. And I want to start with one name, Pramod, which, of course, you guys have owned for a long time as well, which is GMM Pfaudler. The recent news flow on GMM, of course, and the price saw a sharp dip. How did you read this entire sequence of events? I think in November we had in the conference call the management of GMM Pfaudler saying that they have an agreement for 3 years where they stay put. There is no sort of question of selling, etc. And now we got this recently. How did you look at this, and have you done anything with your holding?
No, not really. I mean, we see this largely as a non-fundamental event, right? It doesn't affect the fundamentals of the business in any which way. It is, as far as we're concerned, one financial investor paring down their holding on pretty much expected lines. Now, whether it's 3 years or 2.5 years is a moot point. But by and large, a financial investor, particularly a private equity fund, has a limited life of the fund, and therefore everybody expects them to exit when they've made their gains. They've been invested since 2014, if I'm not wrong. So it's almost an 8-year holding. Any financial investor would be looking to exit. And that exit has happened. It's not a full exit, but I reckon if you look at it from the perspective that 17% of shares outstanding were sold at a 10% discount or 11% discount, is not a bad deal, which means that there are buyers for as much as 17% of the company at those levels. There's another 13% to be offloaded. It may happen tomorrow. It may happen over the next year or so. It's up to the financial investor. But from our perspective, like I said, there is no impact on the fundamentals of the company. Secondly, it shows that there are buyers for the stock at these levels for as much as 17%. So, I mean, we've done block deals when we were on the sell side. If you want to sell that much of a company, that much discount to the current share price is par for the course. So, no change in our stance. We continue to remain happy shareholders of GMM Pfaudler.
Pramod, morning. Rima here. You're looking at IT. I think recently you all invested in Infosys as well. TCS is another holding of Marcellus Investment. Tell us what you expect from the technology space.
Yeah, so I think there's a little bit of weakness in the IT stocks because the market tends to be short-term oriented. Yes, there is a recession in the West, which is the large buyer base for the Indian IT service industry. There will be some slowdown in terms of top-line growth and deal flow, but that is what we look out for. So this is an aberration. If you look at the bigger picture, everything around us is getting digitized. It's very difficult to see why Indian IT services will be of no use in the long run. We reckon that with the advent of AI, ML now, and also early penetration in terms of shift towards cloud computing means that the long-term growth runway for the industry is fairly intact. We look for these times of weakness, and we got into Infosys, another stellar company in the sector. We already own TCS. The reasons that we've gotten into these two is not so much the demand. The demand perspective is pretty intact, like I said, but they differentiate themselves on the supply side. We saw over the last 2 years when we had the whole tech boom during COVID, we had a significant run for talent in the industry. People had to end up paying 30-40% wage hikes. We saw margins getting crunched for pretty much the entire industry. But these two companies stand out in the sense they have invested over many decades in terms of developing training infrastructure. There's a supply side constrained industry. So you will have bouts of what we saw the last 2 years. So unless and until you are able to train and retrain tens of thousands of employees in upcoming technologies year after year, you will see your margins coming under pressures. Therefore, we've chosen the two who have perhaps the best supply side in Indian IT services. And like I said, the demand is intact from a long-term perspective.
Are you exploring investments in other IT names, or would you continue to stick with these two, Infi and TCS?
No, we're always on the lookout for new ideas. Never say never. We do take a long time before we get the sort of conviction that we need. We tend to hold concentrated portfolios. Therefore, the conviction levels required to buy into a stock are significantly high. That requires a lot more in-depth research and perhaps longer time. Yes, that means that we do need that patience. We're happy to be patient in finding new ideas. So we'll continue to do that. But for now, I think we're quite happy with these two.
Pramod, morning, Nigel here. Pramod, the last time we chatted, I think you all were doing some bit of a study, or you were giving a look at Nykaa. Those Zomato you all mentioned didn't pass muster. What's the update out there? Have you all got into any of these new age themes, so to call it?
No, not really. I think the concerns remain the same on Nykaa as well. So like I mentioned, we do think it is a decent franchise, one of the rare few new age companies which have been built with very little capital infused, unlike the norm, which is you burn more capital to gain market share. We are not fans of that type of franchise building. Nykaa is an exception which attracted us to them. So we've been looking at it. We've been digging deeper in terms of trying to understand the sustainability of moats there. It is a young company, no doubt. So we'll have to see multiple cycles of this to see how the moats hold up. Because the industry, they're first movers in an industry which eventually will attract competition. We want to see how the franchise fares in the face of competition. Remember, a core part of our investment philosophy is sustainable competitive advantage. And like I said earlier in the call, we tend to take a long time to give ourselves the conviction. Because remember, we're not investing for the here and now. We would like to get conviction that the franchise will hold intact over the next couple of decades, which means that cash flow growth has to be healthy for that much long, which in turn can underpin a valuation that gives us the margin of safety over the current stock price. We're not there yet in terms of Nykaa, but we'll continue digging deeper.
All right, we'll leave it there. Thank you very much, Pramod. Appreciate you joining in, and good luck to you and your team at Marcellus. In case we don't speak again, wishing you all of the festivities and, of course, a very happy new year into 2023.
Thank you. Wish you all the same.
Well, thank you. Well, the Finance Ministry on the 1st of December proposed the issuance of one license for all kinds of insurance of new as well as existing insurance companies. The composite license will facilitate open access for insurers in any line of business. Such insurers will be allowed to enter any segment, life, health, and general. What's the impact of this as it gets rolled out going to be? Let's get some perspective. Anand Roy is Managing Director at Star Health and Allied Insurance. Anand, great to have you back on the program. Thank you very much. Before we get into what your thought process on this is, I just want to get a sense on how business for you has been doing. I was told that you are very consciously focusing on moving away from group to individual health policies. How is that sort of transition going for you? What is the ideal mix between group and retail? Just tell us a little bit more.
Morning. Thanks, Prashant. Thanks for having me back on your show. Yes, so the strategy of Star Health this year has been to focus more on the retail side of business, and more than 95% of our business is coming from the retail, that is the individual customers who buy health insurance policies. And I think that strategy will be our main focus area for the near future. But group business does come to us. We are focusing on the small and medium enterprises, and that is the segment that we are comfortable with. And we have some ambitions to scale up that business too. So I think, the business has been doing well. We have been growing at more than 20% in our retail portfolio, which is the mainstay of our focus, and outbeating the market growth, which is growing at around 14 to 15 odd % for the first half of the year. So I think we'll keep our focus on the retail side.
Okay, all right. So retail is what you're focusing on. Do you have an ideal mix, Anand, in terms of this retail and group? You've been telling us for many interviews now that the focus is on retail, but do you have an ideal mix out there? And given that the mix is changing, it's structural in nature, so what kind of impact it has on margins?
See, retail business is definitely more margin accretive, and that's the reason why we are focusing on that. But having said that, the group business is also of interest to us, but we are choosy in that segment and we are focusing more on the SME segment. So typically, if I have to give you an idea, we would be comfortable with a 90-10 mix, where 90% of our business would be retail and 10% would be from groups.
Okay.
Okay.
And in terms of margins, what could it mean since, as we know, retail is better?
Yeah, so Star Health has been an operating profit-making company for the, even during pre-COVID times. And for the first 2 quarters, we have also come back to, doing business in a profitable way. So I think that will be our focus. And that's largely because of the business mix that we have. And as you can compare with other players in the industry, most of them do not make operating profits. They are making profits on investments. But we are our organization and our business model is more focused on operating profits. And I think that's where the focus will continue.
And just one clarification. Earlier, you were telling us that 95% of your business is now retail, but the ideal mix is 90-10.
From the next financial year, probably, yes.
Okay. And for FY23, what's the mix that you will end with?
I think we will end with 95-5.
95-5. Okay.
So you're actually going to increase the group business a little bit, right?
Next year, probably, yes. We are seeing some improvement in the rates.
Sure.
So we will be selective and we'll try to be, more aggressive there.
What's the extent of improvement in the rates for the group business?
See, over the last 6 months or so, we have seen some price corrections, but still not very profitable in all segments. Now, group is a very large business segment. You can't just, give it a single brush. So in the large corporates, we have not seen great price correction, but in the middle corporates and the SME segments, we are able to see some good corrections.
Okay, so this increase in group business from 5 to 10%, will that be catered to the mid-size, the SMEs, where we have seen some improvement in rates?
That's correct. That's absolutely right.
Okay. Were you on any of the committees which was constituted to give suggestions on these on the recent Composite License Act and the amendments? Were you on the committee, and what were the suggestions that you all made, or the industry body made?
So Star Health was represented on most of these committees, but the one which you're talking about from the composite license, I think that has come from the Ministry of Finance, and all the companies have been asked to give their views on that. So these are interesting developments in the insurance business. As you know, there has...
What was the view that you all gave?
So, see, we have been always talking about, there has been discussions in the past about life insurance companies being allowed to do health insurance business and so on. And now the discussion is about giving a composite license to all companies to do all classes of business. As you might be aware, now there have been 4 classes of business which has been identified: life, general, health, and reinsurance. And except reinsurance, I think any licensee can operate in any of the classes of business. That's the composite license model. So we will see how it spans out. But I think, this has been under discussion for some time and we are well prepared for it.
Anand, some part of the street believes it could be a challenge to your business. The health insurance business, if the composite insurance comes about, licenses are given. You want to comment on that?
Oh, definitely. It will be challenging to all businesses because now the opportunities of cross-selling each different products is going to become available to many companies. But the companies that will thrive and prosper are companies which have a sustainable business model, which we believe that we have. We have a very strong distribution platform. We have a granular, agency base across the country. So I do not see this as a threat to us particularly. But I look at this as an opportunity because this gives us some scope of evaluating whether we can look at other lines of business also, because we do have the distribution and the service network across the country. So we look at it as an opportunity. Let's see how it goes.
So will you start distributing life insurance products or will you apply for the composite license?
See, Nigel,
Anand, try to give us some sense at least. I know, it's a little difficult, but at least give us which direction are you all headed in?
See, I can tell you that, a few years ago, we had a product called a combi product. Okay, the combi product had term life, health, and personal accident all into one. Okay, it did not do too well at that point of time, but I think the time for that product has come. We may look at those kind of products because it gives a pure protection to all to the customers that we are reaching out to, and I think that will be something interesting to us.
Anand, could it be, if you stay in your lane, we'll stay in our lane? Kind of, you'll watch what competition. Obviously, you'll watch what competition also does, right? I mean,
absolutely.
So I mean, you're being very guarded, of course. I mean, because I'm assuming it's an ongoing discussion process at the company. But you're saying that you could introduce some products which cover more, not just health.
Yes, Prashant, you're right. We are evaluating all these things as we speak. But these are interesting times, and we will see how this eventually pans out. These are under discussions. I mean, right now. But I think I strongly believe that given our distribution and the business model and the brand of Star that we have created, I think there will be opportunities for us in this area.
All right, Anand. Before we let you go, just a quick guidance about FY23. Retail obviously is growing at a faster clip, but overall for the business, what kind of a growth could you tell us? I think you were talking about 18 to 20%, if I remembered, for the entire business, with retail growing faster. Stick to that?
Yes, we stick to an 18% growth, and we believe the retail will grow at 20% plus, and with an overall combined ratio of around 93 to 95%, we should be able to deliver our numbers this financial year.
Anand, we leave the conversation there today. Thank you very much for joining in, and season's greetings to you, and a very happy new year to you, your family, and everyone at Star Health in advance. Need to slip into a very short break. Up next, we will be chatting with Akash Sethia, the head of strategy at Ellen Electronics. Its 475 crore IPO opens today. On the other side, we'll also connect with Sailesh C. Mehta, the CMD at Deepak Fertilizer, as the company announces the demerger of the mining, chemicals and fertilizer business. Stay tuned.